Hello and welcome to the show. I'm Kim Parley. Thank you so much for joining us tonight. Well, the big news today, U.S. Republicans have pushed through Congress the most significant tax overhaul in more than 30 years. The changes could have big impact on some companies, but it's also likely to impact economic forecasts for the coming year. Joining me now, TD Chief Economist Beata Caranci to explain what those impacts will be. It's great to have you here.
Thank you.
This is a really big deal.
Its total amount is $1.5 trillion over a decade. And even when you do what's called dynamic scoring, so how you get some offset from stronger growth and other aspects, it still leaves you with a price tag of about $1 trillion. So this is a big deal, but one that will continue to have to be paid back for future generations.
You know, when President Trump was elected, we all talked about the Trump bump. This was the Trump bump. It was the investors saying, okay, if companies are paying not 35 but 21%, that means more money hopefully going to us. Tell me a bit about, in terms of when you look at this, how do the benefits get distributed throughout the economy and what's it going to mean?
So if you think about what they're reducing in terms of taxes, you almost not quite 50-50 split between what's going on in terms of corporate income tax benefits versus personal side. So you and I getting tax breaks if we were Americans. On the corporation side, the tax rate's going from 35% to 21% is a huge shift. You're hard pressed to find an economist who's not going to like that aspect, because the U.S. really did have non-competitive tax rates. They hadn't changed them well over a decade, while all the other countries were coming down. On the personal income tax side, this is where a lot of controversy exists. What they've done is a higher distribution of tax breaks going to the higher income individuals. So the people who are in the top 5% of income are going to see their after-tax income rise by about 4%. People who are on the lower distribution are going to only see about a 2% increase in their after-tax income. So much more going up. And what that means in dollar terms is about $13,000 on average tax breaks to an individual in the top 5%, and about $900 in tax break if you're earning between $40,000, $50,000 and $80,000.
Now, the other thing I know, because I've spoken with you many times, and I listen when you speak to me, is that when the higher income gets the tax break, they are less likely to actually put that back into the economy. They're not going to spend it. They're going to invest it or do something different.
Yeah, they're flush with cash, and so they don't treat additional savings as something that they need to go out and spend. So it's called, their propensity to consume is much lower out of every dollar of savings. So we'll go through into investments and other aspects, as opposed to lower income individuals who have a high need for basic necessities, or maybe doing the vacation they deferred, or other aspects, new car repairs. So that money tends to go almost immediately into the economy, and it has a much higher fiscal multiplier. And so this is why when you distribute to the higher income individuals, it tends to be saved. Where they do spend, they may spend on luxury items more, which tend to be imported. So you don't even get the same multiplier happening inside the American economy.
But you'd have people also arguing the same point, though, with the tax rates lower than, I think it's the OECD average, according to your report, that maybe can attract more businesses to set up shop in the States, maybe?
This is the hope. What ultimately is the belief is that you, one, reduce inefficiencies that are getting created. So we know there's a lot of companies who set up shop elsewhere to avoid paying the higher tax rate in the U.S., and they maintain profits elsewhere in operations. And so that incentive should be reduced, and you'll set up where it makes sense. And that could lead to higher investment in the U.S. This is the hope. But it doesn't happen immediately. It tends to happen over time, because businesses, just because they wake up on January 1st with lower tax rate, doesn't mean they're going to throw their previous business plan out the window. So it takes time to materialize. So really, the impact would be bigger in 2019 than it would be in 2018.
Well, let's talk about the impact on your forecast, because I know you came out with your forecast not too long ago and then said, by the way, when this happens, you could see this ratchet up a little bit. So is that what you're saying? You saw it move up more in 2019 than 2018 for the U.S.?
Yeah, so we put in about, it's very small, it's a 0.3% increase in GDP in 2019 and about 0.1, 0.2 in 2018.
Why so small?
Again, because we are at a mature stage of the business cycle, and so the economy does not need fiscal stimulus right now. And so people don't, by the same token, don't spend as urgently as when you're in a recession, you really need the money. So you get a lot of leakage. You don't get the same bang for your buck at this stage. Also, the type of spending that we're getting, if they had put the money towards things like infrastructure spending that builds out capital and improves productivity, you have much higher multipliers there than when you're distributing it to higher income individuals.
One thing you talk about in here, I think we have to mention, is that I'll just read what you have. An intergenerational shift of the tax burden to the future. So forget Generation X and Y. We're going to have Generation T for tax. So this is the kids. U.S. kids are going to be paying this for a while.
There are people who are currently not even in the job market who are going to be paying for this. So teenagers, people in their 20s, and even their 30s. So what they did have to put in place is, because it's ramping up the level of the debt, they have what's called sunset clauses, meaning much of the personal income tax breaks that are in existence as of next year will expire, in the next 10 years.
They don't expire, do they?
Right. Well, this is what the U.S. is not good at. They don't actually execute on their sunset clauses. It's very rare.
No one gets reelected on an expiry. So.
Right, because people deem it an increase in taxes, even though you're moving back to where you were. So ultimately, they have to find a way to pay for this. And because the debt level is rising as a share of GDP, it's already on an upward trajectory. Now this is going to add to it. Someone's got to pay that back, and that's going to be the future generations. More and more of taxpayer dollars are going to go to paying the interest on this debt as we go forward. And they also have an aging population that's putting pressure on their Medicare and Social Security system. And so that's what we say when we say there's an intergenerational shift happening. It's that younger generations who's going to be paying for this for some time to come.
You're living up to your dismal scientist piece right now. So but it's something I think people are very aware of. Okay, I want to shift gears if I could, because you mentioned about the forecast. I've only got a couple of minutes here. Wouldn't mind just some rapid fire thoughts on this. U.S. Forecast has gone up because of the tax cut increases. You and I chatted and talked about a virtuous cycle that's happening in the global economy. What are you seeing right now in terms of forecasting and growth?
So we would have upgraded the U.S. forecast irrespective of the fiscal stimulus, and that's because what we're seeing is it's not just the U.S. It's happening in Europe. So the Eurozone forecast was upgraded. UK, which is facing and contending with Brexit, upgraded. Canada also upgraded. So we're seeing basically all the amount of monetary stimulus that was pumped into these economies years ago, and the legacy of the financial crisis now really behind us. You're now starting to see the benefits feed through, and so they're feeding off of each other in many respects, off of that growth pattern, and you see it through higher trade volumes as well. So everybody is getting bumped up on the forecast. Canada as well. Canada had a great year this year, 3% growth. Going into next year, it would probably be around 2.4, so slightly slower than that. But we have tremendous momentum happening in consumer spending, probably where the Bank of Canada would not like to see it, because there's a high level of indebtedness, but it's holding. It was originally fueled from the housing market and that wealth effect. It's now looks like it's switching into wage drivers, meaning we had a substantial amount of full-time jobs created in 2017, the highest we've seen since basically 1999-2000. And that bump up in wages and wage growth is now feeding into the consumer cycle.
I'm asking you one-word questions. NAFTA? I mean, does that just negate everything from a Canadian perspective if something happens?
It's a huge risk. So we did some analysis on this front, and if NAFTA is torn up, and if we go back to WTO, most favored country tariffs, that would mean you're going to have price impacts of 2 to 3% across the board happening. It varies by industry, but that's the average. And when we assessed it, we think it will shave GDP by about 70 basis points, which basically means that you would be somewhere at around 1 to 1.5% growth for Canada, which doesn't seem horrible, but it's a very difficult thing to model. And what we think is you'd probably have 2/3 of the negative impact coming not through the trade, actually through confidence. So we think there'll be a substantial financial market shock happening in the stock market and currency markets, business confidence and consumer confidence. So we're saying maybe 1.5% growth, but it could actually be, the risks are skewed to the downside to those numbers.
All right, 30 seconds. I have to ask you what the province is. Ontario
for next year will look similar to Canada in terms of the growth.
And with NAFTA, disproportionately hard?
And NAFTA, Ontario is disproportionately impacted because it has a much stronger trade tie to the U.S. than, say, British Columbia, which has more trade oriented towards Asia in particular.
All right, and the east coast of Canada, just a little bit lower?
A little bit lower. It's more like in the 1 to 1.5% range.
All right, you tried to make that sound better, but it is what it is. Beata, thanks so much.
My pleasure.
Beata Caranci, Chief Economist at TD Bank.